the Gemeos quantum algorithm. Real broker, USD, 1 to 200 leverage, and it works on rather MetaTrader 4 or MetaTrader 5 with a handful of brokers that we normally like to use that all have tier 1 and tier 2 licensing, so very heavily regulated brokers that this algo will work on. This algorithm trades forex currency pairs. It occasionally trades cryptocurrency, but if it does, it only trades Bitcoin and Ethereum. And it also occasionally trades indices or stocks or like the S&P 500. It's all opportunity based. So this algorithm has 4 different subsystems, so it does not just use one strategy. And if you notice, the very first thing you look at is the gains. These are compounded gains over just over 3 years. Absolutely insane. But prior to 2025, this algorithm is not available to the general public. This was an institutional grade algorithm only used with hedge funds through our quants and developers. This system was only used for that level of trading. Now, exclusively to Gemeos. So the only way to access an algorithm with this type of trading strategy is literally through Gemeos. Now, the one strategy that is used inside of one of the 4 subsystems inside this algorithm is a 17-year-old tested price action, like a fractal and / price action trading strategy that has been refined and perfected over 17 years. Now, obviously, over time, as market conditions change, the only way for a trading strategy to continue to be profitable is if the traders are adapting. So it is an adaptive strategy. It has 4 subsystems, which means 4 different trading strategies that are happening all at once, like simultaneously, and they also hedge each other. So if one trade opens up and it goes into a 1% or a 2% negative or drawdown, there is a chance that one of the other subsystems will catch that drawdown depending on if it's triggered or not within the algorithm itself. And it will open up a trade in the opposite position to help hedge and keep drawdown low while keeping ROI extremely high. Now, there's no way for you to have an ROI this high, like over 10% monthly average ROI, without having one, bigger drawdowns and larger float, which is larger negative floating positions, and 2, not having hedging in place, right? If you wanted to do more than 10% in a month ROI and use a stop loss on every single one of your trades, you would probably have to be risking 5 to 10% per trade to make that happen. And that's not feasible because then your drawdown could go upwards of 100% if you had, half a dozen to a dozen losing trades in a row. You're looking at a 100% drawdown. You're looking at a not profitable system. This is the way that hedge funds and high frequency trading and like really, really high level algorithms trade. They hedge. They do not stop out. Now, there is stop losses that can get hit along the way because some of the 4 subsystems do have stop losses per trade, like the cryptocurrency trades, because cryptocurrency is so volatile. And some of the high ADR currency pairs, like some of the currency pairs that have very large average daily ranges, will have stop losses per trade just because the volatility is so high. But there is a lot of the trades that do not have stop loss per trade as they are actively managed by the algorithm and by the traders themselves. Because this algorithm also has a trade desk with traders that are watching over and intervening manually 24 hours a day over this algorithm. So an algorithm like that produces this high of an ROI needs to be kept in check, not just by AI, not by the AI system in this algorithm, and not by the algorithm itself. You need highly skilled traders. If you create an algorithm and let it run unchecked for an extended period of time, eventually that algorithm will fail, and especially if it's not upkept or updated, and eventually the algorithm will decay and become a non-profitable system, right? The only way to make a system profitable long-term, like 3, 5, 10 years plus, is the best way to do it is to use more than one trading strategy, because then you can swap strategies when one starts to fail. You can swap subsystems. And we're going to get into all 4 of the subsystems in a minute. And this is exactly how this algorithm works. So you can see the average monthly ROI is over 12% with a max drawdown of 28%. This algorithm does have a 35% catastrophic fail-safe. So in a worst case scenario, black swan event, no matter what happens in the markets, there's never a chance that you could lose more than 35%. And that is on basically the fully dialed up version. Right. So for those who are not comfortable with a float or drawdown, like a regular drawdown of between 5 and 15%, because this algorithm carries a drawdown of normally at least 5%, upwards of 10, 15, even 20% on a regular basis, because it's targeting such massive ROI, right? You cannot, have that large of an ROI and not have risk. If you wanted to, there is a half dialed down version. So we basically have a version of this exact algorithm literally just cut in half. So it's risking half the lot size, half the trade per risk. So the drawdown is half. So it has a max drawdown of 14% instead of 28, but an average monthly ROI of 5 to 6% over years, right? Versus the 12% and 28% drawdown you see here. So this is a fully dialed up version. It can be dialed back halfway. That option's already available. We can even dial it down further. Dialing it up, obviously not possible because you do not want to go above a 35% catastrophic stop. Anything above 50 becomes not worthwhile. So this is essentially how the algorithm works. It has 4 different subsystems. 2 of the subsystems are fractal and price action based trading that trade during the US market session. And then it has a trend continuation and price action strategy and a volume strategy that trades during the UK session, which is the overnight session for North Americans. Now, this is live on my FX book, updated track record and trading privileges verified. So anything happening on the master account is happening right here on the my FX book. Now, you can also see it has an average 82% win rate on all the trades it takes. So it is, in 3 years, this algorithm has taken 2,400 buys or longs and 2,600 or almost 2,700 sells or shorts. And it has won 82 and 83% of those. It also has a profit factor over 2. So that means for every time it takes a trade, the trades are 2 times more profitable on average than the losing trades. And you can see that right here with the average loss being only minus 15 pips and the average win being 75 pips, which is much more than 2 times greater in terms of pips. Now, pips always are different depending on the instrument you're trading, like gold pips, Bitcoin pips versus Euro USD currency pair pips are different variants based on the instrument itself being traded. Now, you can go to YouTube and look up pips and why they're different for each instrument. We're not going to go over what the definition of pips are in this video and why they're different between instruments, but this is just a general rule of thumb that every instrument's going to be different. But on average, over 3 years, it is making 2 times more per trade than it loses, and it's winning around 82% of all of its trades. Now, the other thing is one thing to me that does not matter is the Sharpe ratio. So we're going to go over Sharpe ratio as a 0.2 to Sharpe ratio. Normally, with a low risk, low profit system, but stability wise, you would want a Sharpe ratio of 1 or a little bit higher. If you're targeting 5 to 10% a month or greater, you cannot keep a 1 Sharpe ratio. It's literally impossible. You would have to dial the risk way down and then be okay with a way smaller ROI, right? So if you want to shoot for the stars and have a massive ROI, now obviously a Sharpe ratio of less than 0.1 would probably be like extremely low. And even if the system is a really high ROI, anything less than like a 0.1 Sharpe ratio, it's pretty risky. So this has almost a quarter, right, of 1, so 0.22. And you can also go down and look at the losing months and the drawdowns, right? It's going to paint the ROI and the drawdowns in the losing months are going to paint much more of a clear picture to you than a Sharpe ratio, okay? So we'll scroll down and look at the gains since 2022. So 2022, June, July is the very first month of its inception, at least for the 4 subsystem algorithm that is now you're going to be able to trade this algorithm through Gemeos. 2023, and you can see it's very consistent, but it also has some ups and downs. So you can have a 17% month and all the way down to like a 5% month, right? But overall, generally pretty consistent. Also, during different market conditions and different economic environments, you're always going to have different results. You can never expect always winning months, and you can never expect the exact same result every month. That's impossible, right? But you have 5% months, even losing months of a few percent. Now, having a 2% losing month on a system that has this high ROI monthly is pretty insane. Generally, systems that have 10, 15% months or 5 to 15% months, you're going to also see 5 to 15% losers as well. But being able to see that the losses are normally kept in single digits, and it's normally only one month, sometimes 2 months per year of a losing month in a year annual window is very, very solid and very stable for how high the ROI targets are, which is very impressive, right? And if you go to 2025, we have a very, very stable first half of the year. And then we have 8% month, 4%. And then we have a record-breaking month and then a loss, 8.6% loss in September. And then a record-breaking month of all time so far, 26%. Now, right around here is when one of the 4 subsystems started to fail. It started to decay. So one of the 4 strategies started to not perform well. 3 of the 4 strategies were still doing good, but one of them started to not do so good. That is when we introduce a new subsystem that uses volume-based trading. That is the main reason why drawdown up here, you can see the drawdown was relatively low, normally below like 5 or 6%, all the way up until spring to summer 2025, which is when we added a new subsystem. And that new subsystem is a volume-based trading strategy. So that way we could keep 4 subsystems running simultaneously, and we can continue to hedge trades and use the 3 main strategies that have been working extremely well for a long time. But you can see the drawdown has increased from 5%, maybe upwards of 10%, to over 20% max drawdown in 2025, and that's literally because of the volume-based strategy as well as the market conditions of 2025. But if you just go down here, you're still going to be able to see the ROI for 2025 is actually the highest ROI of any year to date because of that new volume-based strategy we've added. So it does create a little bit increased risk, a higher float and larger drawdowns, but the drawdowns are still kept in check. They're managed daily by the actual quants at the trade desk, and the algorithm's opening up hedge trades to oppose and minimize the losses and drawdown based on the volume strategy that was introduced. The benefit of introducing that volume strategy, you can see right here. Sometimes we're going to have some absolutely insane months by having introduced that subsystem. But that's essentially where you see the changes in drawdown and why it increased in 2025. So not only the economy with Trump tariffs and dropping a bomb in June on Iran, and then you have tariff on, tariff off, tariffs on, tariffs off, and then you have crypto and stock market huge dumps in September and October this year. Now, September, we weren't able to make any money during those huge dumps. The crypto market dumped massively, and that created a lot of volatility in the markets, and we had one losing month for the year because of that. 2020 October, though, there was some pretty serious volatility, and we caught the right side or the good side of that volatility and had an absolutely record-breaking month. That's the volume subsystem in action right there, helping us pump some pretty crazy results. So what to expect with an algorithm like this? You should expect drawdowns and floats of -5 to -15% pretty regularly, but those are never going to be closed losses. And when they are, you're going to see it, and it's never going to be, it's not going to be massive. And the profitability of the algorithm and stability overall is always going to make up for the losses, right? Like you can see how easily the losses are made up for, but I also want you to be realistic. So let's just say we had this 8.6% loss September, and then we did not have a record-breaking month following. Let's say we only had this month, 8.64. So we recovered in 60 days, right? You made 0.03%. So if you joined at that last week of August, and then your first 60 days, let's say you decided to join and you joined during a losing period, this is realistic, and this is, to be expected. Now you have like maybe a 5% chance or a 10% chance of that even happening in a year, right? If you signed up January, February, March, April, May, June, July, you would not have experienced a losing month in your first 3 to 6 months, right? And you would have been cruising along with some very healthy profits. If you join here, you join at a losing month, and let's just pretend this huge profit month not there. And the following month, now November's not quite over yet. I'm recording this video third week in November 2025, but we technically would have only recovered 6.5 out of 8.5% loss from September. Pretending this month wasn't there. So I need you to be realistic and understand day trading will always be up and down. And 2025, introducing that volume-based strategy is not the only reason you see these ups and downs. You're going to see it every single year, right? Up, down, up, down, up, down, up, down. But overall, across the board, if you go all the way back to the inception of this algorithm, which uses 4 different subsystems, including a fractal price action based algo that's 17 years old, which is very, very refined and very profitable, you're going to see the results of this algorithm deliver long-term very consistently. So in a nutshell, we have the average ROI, we have our drawdown, we have average win ratio, we have our Sharpe ratio, we have our average loss versus our average win size. And then we can also just look at the basics, the FAQs in a nutshell. So we just pop over to right over here, try to keep this short and sweet for you guys, but at least informative enough for you to get all the information that you actually desire. Now we have 4 really big documents that are like multiple pages long. I'm not going to go over those with you here, but we can send them upon request if you want to get into basically a deep dive into the subsystems and the float and the fractal based price action strategy and how they actually all work in depth. We can send you those on request, but I do have a basics, which is only 8 points long for us to go over now. So as you know, it is a 4 subsystem, as mentioned before while I was going over the FX book. It is an institutional grade algorithm originally designed for hedge fund environments, but made available to Gemeos clients as of 2025. 2 of the subsystems operates a refined 17-year-old, as mentioned before, price action and fractal-based price action strategy optimized for US market session. And you'll see trades that are happening during US market session are normally going to be this strategy base. Now, the other 2 subsystems run advanced price action and trend continuation and a reversion model during UK sessions. and provides a balanced diversification across market conditions. And it especially helps balance out the fractal based price action strategy for US market. And both of these subsystems have hedging mechanisms. So all four of the subsystems can hedge one another at any time, which is really good. And if you go to YouTube and Google and learn about hedging, you'll understand that one, you have to be really, really good trader to do hedging properly and to end a hedged trade profitably. And they normally can also prolong your trade duration and also increase drawdown, right? If you have a trade that goes into negative and then you hedge it, you're going to be sitting in a floating drawdown for a while. But if you're trying to do 10, 12% monthly ROI or 100% ROI in a year or greater, you're naturally going to be having larger drawdowns and hedging positions naturally, but you got to be really good at what you're doing to do that. And this algorithm has been doing it for 3 years very consistently. Keep in mind, we have a trade desk with traders that are watching over it very regularly, but in combination, the system is very powerful and very profitable. So the system, like I said, activates hedging strategies to mitigate risk on the high volume swings or trades that go against market favor. The algo has a 1 to 2% average profit or 1 to 2 risk to reward ratio, meaning every profitable trade is normally 2 times greater than the losses. It's extremely difficult to maintain this level of profit factor with keeping such a high ROI, which speaks volumes on the skill and strategy used in the quantum algorithm itself, right? Number four, the algorithm is supported by a dedicated trade desk, as mentioned before, with actual quantitative analysis, allowing for real-time intervention when market conditions warrant it. Now, in early 2025, one of our subsystems began to underperform, right? So this is what I talk about. People that sell algorithms, they sell one strategy base only, and that algorithm eventually will decay. Rather, it's martingale, which I would say 60% of the market sells martingale robots, which are very dangerous long-term. And then I would say 30% of the 20 to 30% of the market sells grid-based algos, which are definitely a lot better than martingale systems. But if they're not actively managed or hedged and or have catastrophic fail safes to keep losses in check, even grid systems eventually can go into deep negatives and not do well long term unless actively managed properly. So having subsystems with hedging and price action strategies, like this strategy is a much higher level algorithm than you're pretty much going to find anywhere else on the market. But one of our subsystems started to not do well. So we then switched it with an intraday volume-based subsystem, which is what I was showing you before. We had some record-breaking months, partly to do with that volume-based subsystem we introduced to the algorithm. This upgrade also increased the drawdown and float due to naturally higher volatility of the volume trading. But it also produced several record-breaking months, right? 22.5% in August and 26% gains in October of 2025. Pretty crazy. Max drawdown 28%, but there are systems that do 3 to 4% a month. So a few percent a month with similar drawdowns, right? We also have a half risk version of this algo that still produces very high ROI and half the drawdown. If you'd be more comfortable with that, we can always accommodate. Sharp ratios, again, something that I don't think matters very much. Now, if you started looking up sharp ratios, you might have people convincing you, or like banks and stuff convincing you that sharp ratios are important. They are, but having a sharp ratio of 1 or above is only important if the system is targeting you 5 to 10% a year, not 5 to 10% per month, right? So with our system, it has any system that basically does more than 50% a year, very high ROI, will always have a lower than 1 sharp ratio. Now ours is 0.23, actually, not 22. Sorry, not 23, it's 22. That does over 130% annual average, right? So sharp ratios were originally designed for slow, linear, low volatility funds like ETFs, pension funds, mutual funds, going for these low annual gains, not systems that do 10 times that. So you have to keep that in mind when you're looking at sharp ratios and you have anybody telling you about that. Say, what if the system does 130% a year and it still has a 1 to 2 risk to reward ratio and an 82% win rate? Absolutely monstrous, right? So sharp ratio, not crazy important, but again, it's still not a bad sharp ratio considering the ROI is so significantly high and the risk to reward is so high. And now, unlike most algorithms that do degrade over time and eventually fail, our framework allows individual subsystems to be seamlessly replaced. So our subsystems, our developers and team are constantly building and testing new systems that are very high performance to ensure long-term stability. And if a subsystem needs to be switched out, like we did with one failing price action trading subsystem this year for a volume-based trading subsystem, we do that constantly. And that way the algorithm is going to be able to continue to run profitably, successfully, but you will see changes from time to time, right? So if we go back to the FX book, You might say, hey, for 2.5 years, you had very low drawdown, but you never had a month above 15% profit. So now the drawdown has increased since we had to get rid of one of our subsystems, but we also have now had record-breaking months thanks to introducing that new subsystem. So volatility's gone up, drawdown's gone up, but so has the ROI, right? So if you go back to 2023, 2024, it was doing about 120, 110, 120% annual average. This would have been a little bit lower than that. This might have been maybe 105 or 115% that year. 2025 has already done a higher ROI than those last 2 years prior, and we still have 6 full trading weeks left for the year, all thanks to introducing that new algorithm right around summer 2025. So that's pretty much it for this video. I hope this explains in depth how the quantum algorithm works, what to expect, drawdowns, profit loss, risk reward factors, drawdowns, all that good stuff. If you have any questions, just refer back to the person you're speaking to, and I hope this helps.